every bank will fail. That's what economist Peter Schiff is warning. It sounds extreme, even unbelievable, but when you look at what's happening, it starts to make sense. The U.S. economy is drowning in debt, inflation is eating away at the value of money, and the banking system is more fragile than it seems. This isn't just about one or two banks shutting down, it's about a chain reaction that could affect everyone. Your savings, your job, your future, it's all connected. In this video, we're going to break down exactly why Schiff made this bold prediction, how the economy got into this mess, and what it means for regular people like you and me. This video will help you understand what's really going on and how to stay ahead. If you want to protect your money and your future, this is something you need to hear. Let's get into it. Imagine you lend someone $100 and they promise to pay you back with a little interest. That's basically how bonds work. They're loans to the government or companies. But here's the problem. The U.S. government, along with corporations and everyday people, has borrowed more money than ever before in history. And now, interest rates are rising fast. That means the old bonds people already own are worth less because newer ones offer higher returns. So what happens? Investors start selling their bonds, and the more they sell, the more prices drop. This creates a dangerous spiral. According to Peter Schiff, we're not just seeing a small dip. We're in the early stages of what could be the biggest bond market crash in U.S. history. Why does that matter to you? Because when the bond market crashes, it doesn't stay in its corner. It spreads. It hits banks, makes loans more expensive, raises mortgage and credit card rates, and slows down the entire economy. It can even crash the stock market. Schiff believes the U.S. economy is more overloaded with debt than ever before, which means when this bubble pops, the fallout could be massive. This isn't just about Wall Street. It's about your savings, your job, your future. And the more you understand this now, the better you can prepare for what's coming. Back in 2008, the world was hit by a huge financial crisis, and it all started with subprime mortgages. These were risky home loans given to people who couldn't really afford them. At first, they seemed safe, but when people started defaulting, the entire system began to collapse. Peter Schiff is now saying we're in a similar situation, but this time, instead of risky home loans, it's U.S. Treasury Bonds that are the ticking time bomb. Treasury bonds are usually seen as the safest investment because they're backed by the U.S. government. But now, with inflation rising and government debt exploding, that safe image is starting to crack. Schiff says that just like in 2008, investors in Wall Street are blind to the real risk. They don't see how fast inflation is eating away at the value of these bonds. Imagine buying a bond that promises to pay you a fixed return, but then prices rise so fast that your return is actually worth less in real life. That's what's happening. If people lose confidence in Treasury bonds, it could trigger a massive financial panic, even worse than 2008. Schiff calls it a bigger surprise than the last crisis, because most people still think Treasury bonds are rock solid. But when trust breaks and inflation keeps rising, we could see a wave of selling and losses that shake the entire economy. This time, the safe bet could become the next disaster. Think of the economy like a patient with a serious illness. Instead of treating the root cause, the Federal Reserve keeps giving it painkillers. Those painkillers are interest rate cuts. When the economy slows down or gets shaky, the Fed lowers interest rates to make borrowing cheaper. It's like giving the economy a sugar rush. People spend more, businesses take more loans, and the stock market gets excited. But Peter Schiff warns that this strategy is only hiding the real problems, not fixing them. Every time the Fed cuts rates, it creates more debt, more bubbles, and more risk. It's like covering up cracks in a wall with paint instead of actually fixing the foundation. Schiff believes that all these low interest rates have inflated massive bubbles in stocks, real estate, and debt. And the longer we delay the real correction, the painful but necessary process of letting these bubbles burst and the market reset. The worse the crash will be. Imagine a balloon that's overinflated. You can keep blowing air into it to keep it from shrinking, but at some point, it's going to pop. And the more air inside, the louder and more damaging the explosion. Schiff is saying we need to face the pain now, higher rates, falling prices, tighter credit, so we can build a stronger, more stable economy in the long run. If we keep avoiding the correction, we're just setting ourselves up for something even more severe down the road. Don't forget to hit the bell icon so you don't miss what's coming next. To find such valuable content, you can watch this video right here.